So just to start off, my experience. So I've been looking at Africa for close to a decade now. Africa fixed income, that is. And I think the fellow panelists here as well have looked at Africa for quite some time. And I think, COVID is just one of the many crises, if you like, that have befallen Africa fixed income. I think Africa fixed income has lagged Africa equity as sort of like a mainstream asset class to most investors. It's a bit lagged, but it's gaining notoriety, especially of late. And progressing really nicely, and seen as an alternative and a more diverse, compelling case investment for its strategy. For monetizing, all the fundamentals that come with Africa. I think it's very important at this stage, even with COVID, to remain positive and to think about the fundamentals that underpin the African investment case. From the growth story. And others. I think when we get moments like this, we tend to question a lot. I've heard a lot on, what are the rating agencies saying? Are they, what about debt restructuring? What about debt forgiveness? But these are not new topics. If you followed Africa over the last decade or so, there was a time when there was Fed tightening, same issues were coming to play. And also the honest reality is not all issuers are the same, right? It's just like anywhere else in the world. Some will struggle, some won't. But I'm sure that's what our panelists are here to delve into and to give us. The important thing with COVID is also just to stress as we move along is that COVID is going to be with us for a while, probably up until the end of the year. There isn't any immediate situation where we expect a vaccine anytime soon. Nobody's really the expert on this field. But I think sometimes we need to look through some of these hurdles and come out of it, we will. But what does Africa fixed income look like? So without further ado, we've about an hour. I don't want to eat too much into that. We've got our panelists, and I'll start with my immediate right. I don't know what it will look like from your side. I've got Tyers Low. He's a portfolio manager with 91. I've got Jean-Pierre Duplessis. He's a PM with Orium Capital. I've got Philippe Kopp. He's a managing partner with Miltenberg Capital. I've got Abi Yadav, who is head of fixed income and currencies at MCB Investment Management. Thank you very much, gentlemen, for joining me. I'll ask Tyers just to briefly introduce yourself and your experience in this space. And then also your early reflections on COVID, maybe just briefly 5 to 7 minutes, and then we'll go into the questions that have been proposed. I'll start with you, Tyers. Thank you.
Perfect. Thanks, Stephen. So Tyers Low from 91, previously Investec Asset Management. So I'm a portfolio manager in our emerging market debt team. I look after Africa's region for regional specialists. We also have an Africa fixed income portfolio, because early on we recognized that Africa fixed income, especially local markets, have certain attractive benefits in terms of low global beta, high yields, etc. So we've got a specific standalone product for that. And then I also manage our hard currency strategies, which are broader EM. But Africa, of course, plays a very big part in terms of the growth in frontier markets, increased issuance from a wide array of issuers across Africa. So I've been looking after that for the past 8 years, very much ingrained in terms of what's happening in Africa fixed income, and been trying to drive the growth in Africa. For me, is looking at from a sovereign perspective. So my focus, of course, more on the macro side of things, is which countries have, first of all, the balance sheet space to deal with this crisis. The initial impact, which are exposed to the direct impacts. You've got tourism, remittances, and you've got oil. So Africa has various different exposures. But secondly, is coming out of that, which economies have done the necessary reforms, have created the space to really find growth, find the right investments post-COVID. Because I think, as you said, COVID is going to be here for a while. But I think the most important thing that we need to look at are which countries can deal with the shock, how can we as investors, of course, help those countries deal with the shock, and then which countries will succeed in that battle from a macro sovereign perspective, and which ones won't, because we will have situations which we talk about. We'll talk about Zambia, for example. You will have the restructuring, you will have the defaults, and it's the question of how wide that net is going to be within Africa. I think for now, the initial result has been, as you would expect, you've got large IMF and liquidity support. That does solve a large part of the external financing gap for these countries. The question is going to be if you have a second wave, or you have a really bad wave in Africa, because Africa hasn't really been hit to the same extent that Latin America has or that Europe has. If that does happen, what does that mean from a sovereign perspective? Because we want to be bullish, but of course Africa doesn't have the balance sheet space. And how can we generate that kind of balance sheet space for countries to deal with this shock?
Okay, thanks, Tyus, for that. I think you raised some very important issues. Maybe I'll come back to you later on that. I think, but for me, the first one is the diversity of countries within the Africa fixed income space. You know, we don't always like to compare with Africa equity, but the big markets on the Africa equity side are Nigeria and Egypt. And pretty much when they choke, you know, pretty much the whole asset class kind of falls to bits. But with Africa, you've got, you know, Angola, Zambia. Those are probably the smaller countries in the space, and you've got as far afield as Egypt and Tanzania. So so that's a very important point. I think you also raised a good point right at the end about COVID and the second wave that we've been talked about. I think if you look at the background this morning, China, for example, you know, there are more cases in Beijing, which is by far the most important city in China if you look at it. But I think the most important thing there is, which is also maybe a subject that you might want to talk about, and it would be interesting to hear your views around the lockdown in Africa. It's pretty much been, it hasn't been enforced as much as in other parts of the world. So how does that relate, you know, even if the second wave were to come? So those are some of the things maybe you might want to touch on later. I'll pass over to JP. JP, over to you, please. JP, I think you're still on mute. Okay, just mute. I think you are still on mute. If you can hear me, JP. Okay, Okay, let's move on to Felipe whilst JP sorts out the hardware. I think there's something going on there. Apologies for that. Felipe, over to you, please.
Sorry, JP. Okay, thanks, Stephen. Catching up in a minute there. Yeah, so as a quick introduction from my side, I'm in the Africa investment management business on the buy side since around 7 years. Have been on the sell side before, coming more from a corporate investment banking and then trading background. Moving to a company in Mauritius called iPro, one of the oldest wealth and asset managers in Mauritius. They already had at that time an African equity fund. So iPro and by extension Mauritius as a market has been traditionally much more of an equity-driven market. And as most of you might know, Africa also, the story began much more in Africa, like you rightly said, Stephen. Equities has been the name of the game for a very long time, while fixed income is still sort of a niche product. So at iPro, I took over the Africa Market Leaders Fund. Then we seeded in 2014 a dedicated Africa fixed income strategy called Africa Total Return. And so that's running now since 6 years, has done pretty well, like many people active in that asset class, obviously much better than equities. And yeah, so in 2019, we decided to carve out that business to create more focus and really have a full-fledged Africa-focused management boutique called Miltenberg Capital. And that's what we have done since around a year. So we manage two funds, the Africa Market Leaders Fund and the Africa Total Return Fund, both domiciled in Mauritius. our investment philosophy on the fixed income side is a bit like Thies already has alluded to. It's I would call country bottom up. We are very much bottom up equity investors. We apply sort of the same logic as much as is possible to countries. So like to analyze countries' balance sheets, cash flows, as with any corporate credit issuer, as we would do with any corporate credit issuer. Now, having said that, in the last years, and I think we touch base on that later, Stephen, as you have put it on the agenda, we also see particularly value in the Africa corporate bond space. So I believe with all the issues we're now facing with G20, China, IMF, World Bank, and all the diverging interests there and the opacity of these whole discussions, I believe if you look at a corporate in Africa and you can analyze the balance sheet, you can analyze the cash flows, you can make much more granular forecasts, you get audited financial statements, which are much more timely. So I believe that in Africa, many of the good corporate issuers are as good as the sovereign issuer, and in some cases even better. Yeah, thanks.
Thank you for that, Philippe. I think, yeah, like you said, you're touching on some really important issues there, I think, around different strategies in Africa fixed income. You rightfully mentioned it's a niche asset class. I think a lot of our investors are still trying to figure out how does it actually work. Obviously, the domineering part being the Eurobond space, the USD space. But you're right, yeah, corporate space has also been growing quite exponentially, especially the unlisted side, but also the local currency side, which we'll try and touch on later. Okay, I'll ask Abi to introduce himself and tell us a bit more about himself. Abi, over to you.
Okay, hi, can you hear me?
Yes, we can hear you. Go ahead.
All right. So thanks. My name is Abhi Yadav. I head the fixed income team at MCB Capital Markets Investment Management. So I've been doing this for 7 years. We have primarily two funds. We have an active fund, which invests in African fixed income. And also we have an ETF, which we launched recently, a year and a half back, in partnership with the African Development Bank, which invests solely in local currency debt across Africa. So we're very focused on working with the FDB in partnership to help grow the local currency capital markets in Africa. I mean, everybody knows and breathes the Eurobond space, but it's the local capital markets that we are even more niche within the African fixed income universe, and we think that's where growth would be. And we want countries to essentially start issuing more in the local currency than dollar bonds. That's the AFDB initiative, and that's what we are working on helping with, essentially with a fund to channel money over there, but also just generate interest in the asset class. And I started doing this 7 years back. Before this, I was in New York for 10 years working for a fund management house. And I joke, when I moved over here, there was a time when, because we run multiple strategies, on the same day, I bought a Japanese bond yielding negative 0.1% and a Zambian bond yielding 30% in local currency. So spreading the whole gamut. But yeah, it's been fun. It's been fun to see the asset class grow. It's been fun to see local currency bond markets develop. Sovereign, really. We hope the corporate bond markets eventually catch on. But there is a growing interest in the local currency space, and especially during COVID-19, I'm sure we'll touch about that. But it was pretty heartening to see how local currency bond markets actually outperformed almost all our peers, whether it's EM hard currency, EM local currency, US high yield, even African hard currency Eurobonds. So local currency bonds across Africa outperformed with lower drawdowns and lower volatility during the COVID-19 setback. So it's an asset class, but like you said, I mean, it's all under allocated. It has always been under allocated, but similar to EM local currency, which really started booming around 2000, I think Africa is under allocated and just needs webinars like this to bring things up to light and hopefully gets into people's allocations.
Thanks a lot for that, Abi. I think, I've been a big fan as well of the Africa local bond, and I think it's, you preferably you want every country to be able to borrow in their own currency because of the currency risk and all that, and to grow their yield curve so that local corporates and other issuers can benchmark off the sovereign yield curve. So that's quite interesting. I think you bring a good, nice angle there for some of our listeners or attendees who would want that area exploring. We'll touch on that a bit, especially around the volatility during the COVID period. Obviously limited there because you could argue not as much in terms of foreign ownership for some of these local, but that is growing as well. In some cases, it has grown quite exponentially. We'll try again with JP. JP, are you ready? Over to you. All right. Okay, it looks like we're still having a problem on JP's side. So what we'll do is we'll move on to our first question, which I think probably you've already touched on. The first one is just around the performance of African fixed income asset classes. Obviously, depending on your strategy, it'll be nice to get a diverse sort of like input from the panel in terms of not just the return side, but the volatility. You know, liquidity as well was thin in some cases in that space. How does it compare naturally to how does it compare to previous events, say, for example, Fed tightening or the oil crisis in 2015, 2016, you know, for, say, the Eurobonds or Nigerian local currency to Abi, that kind of thing. I don't know if you had the last bit, Abi. You went offline a bit.
Yeah, I did. Sorry. So you're talking about comparing local currency with hard currency bonds?
So essentially we're going to talk about performance in Africa fixed income, and I thought maybe just to kick off, if you can start with the local currency side, talk about some of that performance that you're talking about, maybe in more detail this time, and some of the volatility as well.
Sure.
You know, how did it compare to previous crises? Say, for example, in Nigeria when we had the first oil crisis this decade, which was around 2014, 2015, you know, and oil prices. And also maybe because pre-COVID, we already had the Saudi Russia impasse, you know, and all that. How did that affect some of these local currency? And also with the ETFs, maybe you might want to comment a bit on liquidity, you know, how is that?
Over to you. Yeah. So the first, essentially the first thing to answer this question, we needed data. And across local currency, it was hard to get data. So what the African Development Bank did essentially was work with Bloomberg to create a benchmark of local currency bond markets across Africa. So we've got South Africa, Nigeria, Egypt, Kenya, Ghana, Zambia, Botswana, and Namibia. So Bloomberg's got a bond index now, which spans 5 years of data, which is good because historically it was just hearsay. I mean, yeah, you've got this yield, but you didn't have anything to show you total returns in the local currency bond market space. So now we've got data. We've got 5 years of data, which Bloomberg has collected. We can interplay and use that across bond markets and across asset allocations to see how it fits. With that, we've been able to see, and what we did was, at least over the last 3 years, so we used data from 2016 to 2020, 3.5 years. And the 8 countries that I mentioned, if you look at their bond markets have done phenomenally. I mean, you've got really good returns in the local currency space. Yields are coming down. Even if yields are not coming down, the carry is fantastic. But if you get the FX side also, not a single country out of the 8 that I mentioned has lost money on a dollar basis in total return terms over 3 years, annualized. This includes countries like Zambia also, which lost around 30% in their FX over 3 years. But the bond market was up 45% local currency. So you made 15% on a dollar basis, local currency. So, everybody looks at Africa investments and they look at FX and they're like, oh, I don't want to invest because FX is too volatile. But with local currency, obviously you're getting the bond along with the FX, and that's where the attractiveness is. And it's been we present this to clients, and it's great to see their eyes when the perception versus reality suddenly dawns on them, that the perception is African FX drives everything, whereas the reality is that the bond market significantly overpowers any FX-driven depreciation you get from the asset class. So local currency has done very well over the last 3.5 years. And even during the COVID thing, like I said, local currency, primarily because of carry, did very well versus FX. Returns were still negative, but the index was down 4% versus, say, African Eurobonds, which were down double digits, around 15%. They've all come back up again because the Fed is buying dollar bonds, so that interplays with African Eurobonds. We don't have that backstop in local currency space, so that is a risk to look at. But essentially, because of what we've seen historically, Volatility is low. They've overpowered FX-driven noise. And what is interesting in the local currency space now, and this is the first time I'm seeing this, is that countries are actually cutting interest rates in a crisis. And this is very interesting because they've never been able to do that before, because whenever there was a crisis, the likes of South Africa and everybody were raising interest rates to get hold of the dollars that were getting out of the country. This is the exact opposite now, primarily because most of the countries don't have significant external debt. So they're not really grappling for dollars anymore. And their local bond markets have become much more developed than they were before. So they're actually able to do pro-growth policies like developed markets, which is cut interest rates in the face of a crisis, which is a good development, I think. And central banks are getting more developed now in Africa.
Yeah. Yeah, Abhi, just a quick one here. We've got a question here from one of our attendees, Gerald. So Gerald asks, if you strip out Nigeria and Egypt, what does liquidity and yield in dollar terms look like for the balance of the countries? You know, this is, so I think you always come back to that dollar and what you've said, you know, perception versus reality. You know, there's always that worry, especially when you look at Nigeria at the moment. And then, you know, there's all sorts of demand management and all sorts of, you know, basically, you know, a lot of people feel that the Naira could be devalued or should be devalued. We've been there before, 2015, 2016. So this is where I think it muddies the water a bit. You know, do you want to clear that a bit? And also, what measure of volatility in the local currency terms are used for the African local currency bonds? This is a follow-up question. Yeah.
Well, the local currency I can answer is I use standard deviation in terms of basically comparing across asset classes. But it's a good question. I mean, you know, definitely, I tell people, investors, I mean, it is a new asset class. It's not significantly, there's not a lot of depth in the asset class as yet. So you can't expect the same amount of volatility in liquidity in Ghana as you would expect in South Africa and the local currency bonds or Nigeria. But also the capital market base is smaller also, right? So our index is market weighted, capital market weighted. So Ghana gets a 5% weight versus Nigeria, which gets a 25% weight. So you're playing to the volatility and the liquidity and the depth also when you invest in ETF like ours. But liquidity has definitely been challenging. I mean, Nigeria, for example, right now it's impossible to get your dollars out. It's been 2 months. There's a lot of backlog. So yes, it is a risky asset class. It's not a safe asset class, but it comes with its own risks and growth. Yeah.
Yeah, I guess it comes back to, you know, are you being adequately or compensated for the risk that you're taking? I think JP is back online. Let's see if we can get JP on. JP, are you on? No, we can't hear him. Okay. I suppose the same question maybe whilst we wait for JP again to reconnect. We really apologize for this. Just on your side, Philip, what do you think, or what has been your experience in terms of performance? You know, you're looking at it from a slightly different angle, right? The corporate debt space, is it listed or unlisted? You know, be more specific, and also the risk. So liquidity is an issue everywhere, even in the SA bond market, which is usually very liquid. You know, it dried up a bit, and the SARB had to intervene. So it's not specific to Africa ex-SA. You know, sometimes people they run away with these things about illiquidity and Africa being illiquid, and I think sometimes it's overdone. What's your views, Felipe, if I come back to you there?
Yeah, thanks, Stephen. We have a total return mandate, so that means we are really active across hard currency and local currency, as well as corporate and sovereign bonds, right? So we really do the whole gamut there, which is available across Africa on an opportunistic basis. Yeah, so as Abhi already alluded to earlier on the local currency side, there was certainly a much smaller drawdown compared to the Eurobond side. By the way, Abhi, I think you have a very good counterparty in Zambian Kwacha, so seems to me that you get a very fair pricing over there. But I have also to admit that I haven't been active in that market in recent times, so yeah, maybe not the best person to comment on that. Stephen, if I may, I saw in the chat box actually a comment which I find very well placed in that discussion, which comes back to the, let me just check that. There was a gentleman, Dichabe. Dichabe was stating that, was it not the illiquid nature of local currency bonds that protected them? I think that's really a great point, and that's also what we see all the time in African equity markets. So the niche markets, they're obviously more protected because you have more buy and hold investors locally, the local pension funds, the banks. There's not much secondary market activity, so by definition, the volatility of these bonds or also equities in places like I don't know, Botswana. Cote d'Ivoire and other places is very low compared to Eurobonds, which are held by thousands of international investors and who are acting much quicker on macro events. So in a sense, it gives you a sort of protection if you're in these niche markets during these rocky times, because these markets they react only with a delay and not at all. And if you look in the corporate bond space, that's also very pronounced. So if you own local corporate bonds, they're even less liquid than the local currency government bonds, so they won't react at all. And even in the dollar space, though we have seen some fantastic entry points, when I look at what we have in the portfolio, they have reacted really with a lag of 3 to 4 weeks. What happened in the dollar euro bond space? So by nature, if you're more of a buy and hold investor, or you have more of a buy and hold investor crowd in these asset classes, it will decrease volatility, but it can also be masked, right? Because let's say in the local currency space, if you own a local currency bond, which is just buy and hold, held by buy and hold investor, which doesn't react in price, but you cannot really sell it, and you cannot sell the currency against the US dollar, then you certainly face an issue there, right? And that's also why I believe that these returns, you have to be, you cannot approach African bonds with a very quantitative analytical mind frame in my humble point of view. I think it's very much bottom up like equities. It's an individual investment story which needs to pan out for you to make money. It's not like that you can easily rotate in and out. Even on the euro bonds, I mean, I tried to buy some dollar euro bonds. I tried to sell some on the way down. There were no bids, and then I wanted to buy, and there were no offers, right? So it's a quite a liquid space, and it's more that you do your fundamental research on the countries and the companies, and you're really your buy and hold investor as well, and your investors also need to understand that. So for instance, luckily we didn't have any outflows. So investors who understand that as a class, they really like to take a long-term view on that. And as Abi highlighted, there's decent carry to be earned, so you can collect the carry. It's the bid-offer spreads are very high across bar maybe some markets like Nigeria and Egypt, where you have tighter bid-offer spreads in the local currency market. But apart from that, it's quite high. So it's really much more strategic asset allocation and really long-term investment. If I may also, Stephen, if you just allow me on the point of currency and carry, what Abi also mentioned, I think also while I fully agree with him, and I'm talking my own book here, obviously, like all of us, we have also to be careful with that, right? Because in the end, if you get a real return on an African bond after you adjust for inflation, I think the message what Abi tried to bring across holds very well. So you get over time, you earn your carry as on an adjusted dollar basis, because the currency will at some point with a lag adjust to inflation differentials, and as you get your real return, you also should get a positive return, right? But as we also know, in some African markets, the real return has been quite eroded, and now with COVID and what the central banks have been doing the last couple of months, real returns actually turn negative in some markets, and so I would tread with caution there.
Yeah, no, thanks a lot there, Philip. I think for me, you touched on quite a lot of things, but I think there's also one thing that I would allude to, or at least bring. I think what is the second question really, where do these bonds or where do these Africa asset classes fit into your asset allocation? You've got a total return strategy. You're looking at all these potential asset classes, whether it's corporate listed, Euro bonds, local currency, and all that. And Abi as well as mentioned, I think in my previous experience, shorter dated, T-bills, say for example in Zambia, were a good performance kicker, for a typical Africa fixed income fund. So it kind of gives you that kind of diverse Even from a volatility point of view, you deliberately hold corporate USD debt because you want to reduce overall portfolio volatility. So there's many ways to skin the cat, for lack of a better term. JP, I don't know, finally, are you back? Are you with us?
I hope you can hear me now.
I can hear you loud and clear. Please go ahead. Just introduce yourself quickly and just talk about performance and also on your asset allocation and where you fit in. Sorry, I have to compact everything for you to catch up. Huh?
Sure. So apologies. Firstly, hello from Cape Town to all the people who dialed into the call. I was trying to be fancy and talk from a boardroom. I should have just done it from my laptop. I mean, would have been easier. So Laurium Capital, we're based in Joburg and in Cape Town. We've been looking at fixed income in Africa and Africa in general for over a decade. And my history and my background is in fixed income. And I've been, for my sins, a fixed income person for the last 20 odd years. I'm showing my age, across the globe. So emerging and developed markets. Similar to Abby, I've been involved in fixed income in its various forms, all the way from AAA to distressed. So a lot of experience in things which are necessary for the African market. I think briefly on COVID, I think what we've seen globally is, and it's not just related to African fixed income, but what we've seen globally is that countries and companies, etc., that have strong balance sheets, some of the will do better out of this crisis. And the fragilities that perhaps some countries had going into the crisis have been exacerbated by it. So if you've got a country which doesn't really have a strong tax base, is reliant on one revenue source, has high levels of debt, very volatile growth picture, these are all kind of vulnerabilities which have been shown up by the crisis, and we've taken advantage of that. Our main focus at the moment in the funds that we have is on the hard currency, on the Eurobonds. We think that's from a currently where we position, we see that as the better opportunity. We have in the past been involved in local currency markets, but at the moment we're only in the Nigerian market. We don't have exposure to any of the other markets. We are concerned about those countries that haven't really gone through a currency revaluation through this crisis, and liquidity is also at a premium in this current environment, and so we're sort of focusing on the more liquid hard currency opportunities.
JP, thanks for that. Yeah, so I think we're getting the same here. Before I get to Tyus, we're getting the same here. It's Africa fixed income pretty much gives you a very diverse opportunity set, where you can look at different things, and especially with liquidity, you can be able to do tactical asset allocation, which is what I think JP is trying to sum up to say in these periods where liquidity is a bit tight elsewhere. Maybe we might look at overweighting the Eurobond space. Tyus, over to you finally. I could tell you're waiting there. Thanks for waiting. Can you just touch, I'll ask you as well, to just touch on performance, touch on your strategy and how that is all blended in, your asset allocation, how the African bond space enables you to execute that allocation efficiently.
Well, I think I'll echo a lot of what some of the other participants have said, but as Philippe said, you need to be bottom up in Africa, and that's the way Africa fixed income, we all think about total return, right? Am I going to make a positive dollar return from this asset? FX adjusted, I think we place a very high premium on something like liquidity in local markets. So maybe if we sketch in terms of at the beginning of the year in like our Africa fixed income product and even our global EM products, we had Nigerian T-bills, we had Egypt T-bills, we had Ghana local bonds, and you had this frontier local trade. So the first thing that happened is when COVID struck, you understand that liquidity is going to be at a premium. And we can really, I wanted to give Nigeria all the benefit of the doubt. They'll move on FX, but no, they're going to close the capital account and you're not going to get your dollars out. So, I mean, those are the things I think I agree, like over 3 to 5 years, Africa local pays you, right? So vol is between 5 to 6% through crisis, right? And carry is, between 9 and 12% on average. So generally you make your money, but we manage products where our clients can ask their money back. So we need to be quite aware of that. So what we did is we closed a lot of our local, and because it performed so well. So we were quite heavy on our local, and we closed some of our Egypt positions. We sold out of all of our Nigeria positions. We actually went short Naira, because the one thing on offshore NDFs is they were completely compressed, right? 8% to short Naira was ridiculous, right? I mean, where local bonds trade in Nigeria, below inflation, below any kind of rational policy. I mean, Nigeria was a place you didn't want your money. But again, that's the interesting thing about Africa, because on the same side, I still liked Ghana local bonds at 20%, because they have done a lot to improve the liquidity of their local bond market. We traded in and out of Ghana local bonds during the crisis. It was even, I mean, it was more liquid than I thought than we had on some Africa Euro bonds. So you need to be distinctive in terms of how you approach it, and it's all about development of local pension funds, etc. So we cut quite a bit of that risk and we rotated into dollar bonds, because I think we can all agree if you have a dollar asset yielding you 10 to 12%, it needs to be an extreme case for you to lose money. So dollar bonds trading 70 to 80 cents on assets where you need to do the bottom of credit work, right? So you can't just go any asset that trades at that level. You are dealing with credit risks. But we did a lot of work on, debt distress and debt sustainability analysis. And so we increased our allocation towards the Africa dollar debt space. And as Africa dollar debt is now rallied, we're kind of a bit more at a fair value level. And it is more liquid that you can trade in and out. So we are scaling back some of that exposure. We are tentatively looking at some of the local markets, but for the moment, I think we're putting some of that in cash. You're waiting for Nigeria to open up again. That'll be an attractive opportunity. If Egypt starts to move once again, I think the two markets on the local side, which still remain interesting for us from a total return perspective to be involved in, is Kenya. The currency has actually moved. Interesting enough, they are facing challenges, but relative to the historic volatility in KES, that has actually moved. Rates aren't going anywhere. And then the same in Ghana, because Ghana local, we can talk about the fiscal longer term challenges in Ghana, but bonds at 20%, they have over time, the volatility in that currency has just continued to move down and down, and they've become much smarter at managing that, which they need to because they've got a lot of external debt. So we think that from a total return perspective still makes sense. So the book is a lot more, it's still heavier in dollar debt, but a bit more balanced at the moment.
Stephen, I think it's your turn to be on mute.
Sorry, apologies.
Yeah.
Right, it got me as well, right? I was just saying, thanks a lot, Tyler, for that. I think the key theme here that keeps coming up is the rotation, that ability, that flexibility to be able to rotate. Obviously, Abi is obviously in a different strategy here with, dedicated local currency, and I'll come back to you, Abi, in a minute. There's a question for you. I think you'd be happy to I think you've picked up on it on Kenya. And the development. I'll come back to you after just commenting on Tyres. I think that is the key, right? This is what makes Africa fixed income more dynamic and better in terms of as an opportunity set. It's a broad opportunity set that allows you to monetize different opportunities at different times. And that flexibility, I think, for guys who have managed Africa equities, they will be more than happy, to have such a kind of opportunity where they can do Eurobonds at one point, overweight certain countries over others. Look, since March 9, when COVID pretty much started, liquidity, literally dried up. But if you look at the performance of the index, whether it's Standard Bank, ex-Africa, South Africa, the S&P index on the Eurobond space, there's a pretty much V-shaped recovery in line with other global markets. Whether there's enough fundamentals to back that story up, especially with the background of global liquidity conditions that are very ample, or it's a different story. Already 60% recovery from that drawdown, that massive drawdown that we saw in the Eurobond space. It is volatile, but that's what pretty much most of the global markets have been. So Africa is not, especially the Eurobond space, it's not totally on its own. Abi, I'll let you. And the other thing as well is I'm actually glad that without even getting to the question, you guys have started to answer some of the things. Where do you see opportunities? I think, Tyres, you've already touched on that. What you've used on that, I'll probably go to Abi. Abi, if you can take the question, it's from Mark Boland. It says, what potential do you do you see for Kenya to develop its local currency bond market? It seems to be going the wrong way, in his view, with the infrastructure bonds. Do you have any comments around that, Abi?
Yeah, I mean, Kenya is a pretty big bond market in the relative scheme of things, the local currency market, but it's only the infrastructure bonds that really are pretty liquid. The local currency space, I think the issue is, and this is where I think a lot of governments in Africa fall over themselves when they try and build local currency bond markets, is that for some reason they like to get the stock exchange involved. And I think bonds are OTC really. So in Kenya, you have to go through a stockbroker to trade bonds. We've had the same problem in Mauritius where corporate bonds, local currency corporate bonds, are listed on the stock exchange and have to be only traded on the stock exchange. This is the first time in my 20-year career that I had to call a stockbroker to buy a bond. And I don't like stockbrokers. I'm just kidding. But I mean, and what that means is that you basically are stuck with the liquid. I mean, there is no OTC market. Corporate, you're putting a square peg in a round hole. It's very hard to build liquidity in a bond market if you treat bonds like stocks. Kenya's done a bit of that, which is why Kenya is a big bond market, but you don't see much foreign participation in the local currency bond markets, apart from infrastructure bonds. I think that's going to change over time. I mean, when we set up lines with brokers in Kenya, they're like, oh, this is the first time we're getting questions from a foreign investor to invest in our local currency bonds. Do you want to buy equities? So, so I think that has to change a bit. I mean, once they stop focusing on the stock exchange, like South Africa does a very good job. You have all the pricing information on the stock exchange, but trading is done OTC. Is something similar that they can copy over there.
Yeah, I totally agree that I think it's something that I'm actually surprised that it still continues in Kenya. I mean, it is a big problem. Any comments on, or where do you see opportunities in the local bond space? Where you see, I think you touched on that a bit.
Yeah, Stephen, if I may chip on that question from Mark Boland as well, because I reckon he's referring also to the introduction of withholding tax on the infrastructure bonds, and I think there we touch on a very contentious issues, and even more contentious in the current environment where really African governments are reeling on the economic impact of COVID-19, and where the whole discussion about debt relief and the like has started, right? So then, in that environment, requesting African governments to waive withholding tax for foreign investors would maybe be a tough ask, but I think ultimately African governments should look at this more holistically, because ultimately, if they would be more how can I say that, politically correct as you have to be in those times, but more logical, more stringent with their and more holistic with their approach, they would actually have a lower cost of capital. If they would reduce the tax rates or limit it altogether, there would be lots of inflows coming to the market. There would be better secondary market liquidity together. What Abi was said, that there's a better understanding at authorities about market infrastructure, and that bonds should be traded OTC rather than you have to list them on stock exchange, and stockbrokers try to do them on agency basis. I think governments would be, would create lots of interest if they would waive those withholding tax, or at least reduce them. And Kenya has gone in the opposite direction, which is obviously not so positive for our markets.
Yeah, no, definitely. I think you touch on some points there. Yeah, there are some own goals that you think that at least things could be done a bit better. Gentlemen, in the interest of time, if you can keep some of your questions, some of your answers nice and short there. But thank you very much for that, Felipe. I think that's an important point, and I think that's what the infrastructure bonds question is pointing to. The other question that we wanted to touch on before we go too much into detail was, where are you guys seeing opportunity? I think this is, and the final question would be around, what's your outlook short and long term? And what are some of the challenges for this asset class? I think we call it a niche asset class. Some people call it nascent. What is it that is holding back, Africa fixed income from maybe progressing? Maybe you can tie that in with your outlook for the short and long term. But first, before that, let's maybe talk a bit more about where you're seeing opportunity. We've already talked about sovereign corporate bonds, where you could also maybe put that in the mix in terms of volatility, but we've already touched on that. But this is just to give you some pointers and maybe bring it all nicely together. JP, I'll start with you.
Yeah, so I think for us, we remain relatively conservatively positioned in the Africa Eurobond Fund, or the Africa Bond Fund that we run. So we've stuck to the larger, more robust issuers in the Eurobond space, and so we focused on perhaps some of the smaller ones as well. So we've got some Ivory Coast, some Senegal, those kind of countries where we see relative robust growth picture. But we think that there is still some, there's the negative growth rates or extremely low growth rates is still going to have an impact on the overall debt to GDP levels. So we're still a little bit concerned. We stayed away, even before the crisis, we stayed away from the oil producers. We could see some fragilities around them. So, the Angolas, the Nigerias, the Gabons, we stayed away from. We had a little bit of Angola, which we cut, and we continue to be conservative on that. I mean, we've obviously seen a big recovery, but quite a significant sell-off from earlier on in the year. So we're focusing on the more liquid names and in those countries that we think are the most robust going through this crisis. Longer term, we like the space. The 20-odd issuers in the sovereign Eurobond space. We can look at local currency, but right now, as we see more and more issuers coming to market, we think there are going to be more and more opportunities as more countries take advantage of the Eurobond space, and also, importantly, start to really run a debt management program. So we've seen, those countries with curves like Ghana, Nigeria, Kenya, Egypt, where they're actually managing the debt profile. It's becoming much more of a sophisticated market, and we hope to see some more countries issue more and also sort of have a deeper program.
Okay, thanks for that, JP. Felipe, I'll get back to you on this one. What are your views, short term, long term, and generally, what's your view on Africa and the asset class itself, Africa fixed income? What's been stifling its growth, or what's been making it, more compelling increasingly? Your views.
Thanks, Stephen. I don't know if it's a good or bad sign, but Thijs has already mentioned some things we like as well. So I would say Ghana, local currency, is certainly, despite that it has been quite hated in recent years because of liquidity issues on the currency side, and obviously the debt metrics not screening that great, but for the reasons Thijs has already highlighted, and with a decent buffer in real rates, I think that's actually not a bad investment to do. I think also Bank of Ghana is a very well-run institution, should not be underestimated. Addison is a great governor, so yeah, that is one. On the dollar side, after that rally, before that rally, certainly if you can buy Nigeria 2048 at 12-13%, that was certainly a good deal. But if you could do that, but now I think, as Thijs already highlighted, it's looking more fair valued. We had not really the time to discuss this whole debt relief complex, which I think was a story which won't go away. So we are treading more carefully on the Eurobond side. I still believe that Egypt offers tremendous value. If you look at the 30-year bond they issued recently in May, they're still yielding around almost at the issue yield to maturity of around 8.82%, and I think that in a world where you have really dollar interest rate going to zero, that will be one of the most highest yielding government bonds outstanding there. And I think Egypt has good metrics on the credit side, so that could be a good investment. And then there's some bunch of corporate bonds, though. With the corporate bonds, you need to get them first, and also you need obviously to buy them, hold them to maturity. But for instance, there's a bond called Liquid Telecom, right? It's a large, it's quite illiquid issue as well, but it was over 16% yield in March as the sell-off unfolded. So it has the largest fiber network across Africa. Strive Masiwa is the main sponsor of this company, and the CDC of the UK has invested $150 million in equity in 2018. So there are also these little gems. They have a very short duration. They're not very volatile. So these kind of paper, I would say you should have a look as well.
Right, okay, great stuff. Thanks, Felipe, for that. I think just picking up from what you guys are saying, it looks like we've had COVID, right? But some of those fundamentals in the Africa space remain solid, and when I say solid, I don't mean the growth that is going, the recession that we're probably going to see in most of these countries. I think JP mentioned avoiding the oil producers. That's always been an Achilles heel in the Africa fixed income space, especially with the big issuers like Nigeria and others. But I think the fundamental story remains, right? Strengthening institutions, debt management program, all that stuff, and I think that's from what I'm hearing from you guys, that is still very much intact, long term. And I think that has been increasing, and that's the story to tell, with obviously we have some of these crisis, but we'll probably pull out of them. Abi, just on the local currency side, what's your outlook? You obviously mentioned ETFs as well, and the work that you're doing on the local currency side. Where do you see things in, say, the next 3 years or so? And has COVID done anything to slow down some of these developments?
Thanks. So, we have an ETF which invests in local currency debt, which hopefully we're more famous for, but we also have a bond fund which invests in both local and hard currency over the last 7 years. And why I highlight that is because, as opposed to Theus and Felipe, we're more of a top-down shop. We don't look, we look at more top-down when we allocate across African currencies and fixed income. And what we've seen, at least in our active fund, is that over the last, if you look at attribution over the last 3.5 years, 4 years, local currency allocations have actually given us a higher total return than the Eurobond allocations that we've done. So, which is why I am sort of more biased. Yes, we have an ETF on local currencies, but I'm more biased to play Africa from the local currency side because historically it's performed better than Eurobonds for me. Maybe that's where our strength is, but that's why we like local currency allocations a lot more. I would love to be like everybody else and trade in and out of Eurobonds because it's more fun, and local currency is a bit harder to implement. But that's where we see total returns outpowering in a bond fund in Africa. So within that space, dollar is probably the biggest macro variable, so we look at that a lot. But we see the dollar actually weakening going from here. So that being the case, based on that, we like local currency even more. So much like everybody else, Ghana is very topical, very attractive. Egypt is very attractive. And I'm talking about duration, right? So we don't buy bills. We're going up the yield curve. So we're buying like Egypt 10 years. We're buying Ghana 5 year. Nigeria. Yeah.
Sorry, I was saying that was my next
part
question.
of the development of local capital markets is to make, is to get people away from bills, because you want to be investing in bonds rather than bills for bond markets to develop. So so we like Ghana, we like Egypt, Nigeria. We love till it became Hotel California over there. But we like also on the Eurobond space, we particularly like Nigerian banks on the dollar side. We think they're pretty liquid. And liquidity is very important right now. So yes, we're more focused on getting liquidity. So we've cut down on local currency stuff as much as we can in places like Zambia and Ghana, which is much more illiquid than they would be. But we haven't seen much redemptions come in, luckily. So that's helped us maintain our positioning. And we don't expect more redemptions coming in, primarily because we think we're sort of getting over the hump of this recession, this COVID-19. And going forward, Stephen, to your point, we've seen South Africa government, the central bank buying South African government bonds, stepping in a big way to support the bond market. We expect we think Zambia would do that. We think Ghana would do that eventually. So that would lend a bit of a tailwind to these markets, which would really help them perform, because the Zambian central bank sees their yields at 30-35%. They can print money and buy this if everybody else is doing it. So why not do that? And we think that is coming down the line. So that makes it much more attractive if you can fathom the bit of volatility and the illiquidity of FX that comes along. But like I said, local currency has outperformed Eurobonds along with the FX depreciation over the last 3.5 years. So
thanks a lot, Abi. I think you've kind of thrown the cat among the pigeons there with with the sub and their bond buying in the local market. Yeah, you've used the word printing there. I don't know, but yeah, it's I think people have been trying to figure out: is it quantitative easing? What's going on? Are the reserves being drawn down? Are they selling reserves to buy this bond? So, but everybody else is doing it. There's a question here, gentlemen. Basically, what are your views on China as a lender in Africa? And I also wanted to just tie this as we wrap up, right? Just a quick wrap up across. So basically, there's the story. So this is my view, and maybe a kind of starting point. So people are talking about debt forgiveness. We're nowhere back. We're nowhere back to say 2005. When we had the Gleneagles Summit and all that. Hippie countries and all that. It's not the same. Although people like to look at Africa in that kind of scope, if you like. We're nowhere there nowadays. Most of the Africa debt is commercial, even to China. You know what I mean? That's my view. Yeah, some of it, you could negotiate, maybe debt restructuring here and there, but debt forgiveness, I think, is a bit of a stretch. But I'd like to hear your views and just a quick wrap up from each of you guys. Abinatich, I'll start with Tyers here. Yeah?
Well, I think people think China is like this monolithic entity which lends to Africa. I think that's completely the wrong thing. It comes down to the government, right? So China has lent successfully to a bunch of African countries because it does it through different private contractors. Where you see issues is where you've got governance issues within that country. So, of course, China does not have the kind of rules necessarily or the kind of documentation required with some of the lending from Western states, and that is problematic. But where it becomes more problematic for Africa is in the cases of Zambia, which we've spoken about, and this is a problem across the whole of EM in terms of, because they manage it on a project basis, countries who do not have first of all the governance controls or the financial management controls to see how much they're borrowing from China's not going to look after you. You need to look after yourself from that perspective. So I think that it's been good. It's been good for countries. They've gotten access to capital, which might have accelerated the growth. We are worried about how some of that capital has gotten used, but it always comes down to us to the individual countries, because it's really a financial management job for a country to know which debts they sign on to and how that capital is going to get used, rather than just saying it's China exerting their power on it. I think the outside of the kind of short-term opportunities, etc. I think, listen, African local markets are going to continue to grow because these countries are young populations. You're going to have pension funds develop. You're going to have savings industries develop. And that is going to be a positive. We already see that. I mean, we've spoken a bit about Ghana. Egypt is a great example where in the crisis, Egypt was more liquid to trade. Egypt bonds was more liquid to trade than Serbia and Ukraine and all the other frontier markets which guys loved. Because they've got a domestic savings system, a domestic banking system. And I think as that develops, it's going to be very positive for these markets. It's going to be positive for Eurobonds and local currency bonds. It's getting...
Thanks for that.
Now,
no, it's fine, yeah. I'll just move to Felipe. Just quick, what do you think about China? Lending, debt forgiveness. Just in a quick recap. We've just got about a minute to go, gents.
Yeah. It's difficult to make it quick there because it's quite intricate. It's quite entangled discussion. What I feel is that it's more complicated than the market is currently assessing it. I believe there are diverging interests. You have the IMF, World Bank as one block. You have the G20 as another. And then you have the Chinese on top of them. 20% of all sub-Saharan African debt outstanding, including all these bilateral opaque loans, are from China. So China certainly has sort of earned its seat at the table, and it will be very interesting in some cases, even in country like Thais mentioned. Kenya has certainly to a certain degree benefited economically from those loans. Zambia maybe a little less so, but it will be interesting to see, because you see the dominoes falling, right? I mean, there's Angola, there's Zambia, there's the countries who had governance issues in the first place. Then they had also the commonality to have huge loans from China, and those are the countries who are currently under stress, right? And let's hope that in places like Kenya, for instance, or Ethiopia, that things will start to turn out better. For the time being, the market is treating these debt relief like a sort of a junior tranche at a corporate issuer. It's very small. So without China, and everybody's pushing China around, also we have to understand that they're pushing them around to waive debt. China won't waive its debt in many cases, my point of view, unless the Eurobond issuers chipping in.
Yeah, no, I think you're right there. I think Ty has touched on that. Africa is not one big country. There's many countries in Africa, and they're all behaving differently on how they engage all these lenders, including China, which is a significant player, like you're saying. I think it's not a question of China or the IMF or the markets or this. It's a blend of all. And at the end of the day, it comes down to the country and how well the country is running its affairs, in the eyes of any lender, because it's the same yardstick. Gentlemen, unfortunately, we've run out of time, but thank you very much. Thank you very much to our attendees for attending the session. I hope you enjoyed it. And thank you to you all, gentlemen, and our panelists. Thank you.
Thanks, Stephen.
Cheers.
Thanks, Stephen. Bye.
Thank you. Bye-bye.
Bye.
Cheers, guys.